Good morning, participants. I hope you are all able to hear and see me. Anyone having audio problem or video problem, please point out now before we start the class. Your regular faculty is not available today, so I will be taking your classes to today only. So I will start from very left in the last session. So some of the important accounting terms and concepts we will discuss. One is capitalized expense. Normally normal expenses will be, business expenses will be expense to the profit and loss account, but there are certain expenses which are accumulated and not expense as incurred. As and when incurred, these are not expense to the profit and loss account, these are accumulated and normally amortized over a period of time. Like cost of development of a new product. So when a new product is getting developed, lot of costs are incurred over a period of time when the product is getting developed. These expenses are not reflected to the P&L account straight away. This will be accumulated and over a period of time, over a period of subsequent years, these expenses can be amortized. These are called capitalized expenses. So basically expenses are of capital nature. So they get capitalized and then amortized over a period of time. So a very good example is cost of developing a new product. Such cost will be amortized over a number of years. This will be accumulated, then amortized over a number of years. Then we have another concept called chart of accounts. This is nothing but it's a listing of the company's general ledger accounts and their corresponding numbers. So it's basically a list which shows the various GL accounts of the company or the entity, business entity, and there are numbers given to each account. So that is nothing but chart of accounts. Cash basis accounting, you already know it. Under the cash basis accounting, income and expenses are recorded when they are received or paid. So when the money is received or the money is paid, only at that point of time, the income and the expenses will be recorded in the books of accounts. So if somebody sells goods and subsequently receives money after 3 months, then the sales will be recorded at the point of time when the money is received from the buyer, not at the point of time when sales are made. GL is general ledger account. GL is basically general ledger. So the general ledger is basically the main heads of accounts will be there in the general ledger. All income account or expenses accounts, assets accounts or liabilities accounts will be reflected in the general ledger. So example of general ledger accounts are sales, purchases, then fixed assets, inventory. These are various general ledger accounts. come to cash flow. Cash flow is nothing but summary of cash received and disbursed, showing the beginning amount of cash and the ending amount of cash. So cash flow is basically a sort of a, you can consider as a sort of a reconciliation statement. It starts with the opening cash, then the various cash inflows, cash outflows, and the closing cash. So basically summary of cash received and disbursed during an accounting period, showing the beginning cash, opening cash, and the closing cash. That is what is a cash flow. So cash flow is a statement basically which shows the opening balance of cash account, cash received during the period of accounting, cash paid, cash disbursed during the period, and also the closing cash. So automatically opening cash plus cash received minus closing cash should give you the minus cash payments should give you the closing cash. So opening cash, opening balance of cash account, plus cash received minus cash paid should be equal to closing cash. So a cash flow statement basically shows this thing. How much was the opening cash, how much cash was received during the period of accounting, how much cash was paid for various expenses during that period, how much cash outflow took place, and then you should get the closing cash. So it is basically reconciling the opening cash with the closing cash by showing the various cash inflows and the cash outflows during that period. That is what is a cash flow statement. Another important term, because these terms you have to, some of you are already, because I expect all of you have the accounting background and you are already familiar with most of the terms. So you, because we are just discussing these terms once more, because from now on whenever I use the terms, you should not find it difficult to understand what we are talking about. Then comes another term called closing the book or year-end closing. Closing of the books of accounts or the year-end closing. So during this process, at the time of closing of the books of accounts or the year-end closing, the income and expenses accounts will be reversed. All income and expenses accounts will be reversed. And the netting, the amounts will be netted into retained earnings. So basically all income minus expenses should give you the profit or loss for the year, and that will be transferred to the retained earnings account. That is, retained earnings account shows the profits earned by the business over a period of time. So at the end of the year, all the balances in the income and the expenses accounts will be reversed. That means the income and the expenses accounts will be closed. They will have zero balances, and all those balances in the income and expenses accounts will be transferred. They will be reversed, transferred to profit and loss account, and the net balance of the profit and loss account will be transferred to the retained earnings account. So this is what basically closing the books of accounts or year-end closing means. Because at the end of the purpose of maintaining books of accounts is to also determine the profit at the end of each year. So closing the books or year-end closing means basically determining the profit at the end of the accounting period, that is year, and transferring the profit to the retained earnings account. This is the meaning of closing the books or the year-end closing. Then another important term which we may not be using much in our this particular course, but you should be familiar with this term. This is called cost accounting, because we are basically going to discuss financial accounting. So cost accounting is a different kind of accounting which focuses on recording, defining and reporting cost associated with the specific operating functions. So business defines what are the different operating functions, and cost of each function is separately recorded. Cost are defined how much which cost will go for this particular operating function, and this will be reported by the cost accountant, so that the business comes to know at the end during a particular period of time for a specific operating function how much cost is being incurred. So this is a very detailed kind of accounting, cost accounting, which is required for determining cost of various operating functions, and for this the focus will be on recording, defining and reporting costs which are associated with different specific operating functions. That is what the cost accountants do. So business needs to know cost of the various kinds of products they are producing, cost of the various kinds of services they are rendering, because ultimately business has to know whether this cost which they are incurring for a particular product or services, whether they will be able to recover those costs through the pricing of those products and services. So they must know how much cost is incurred for a particular product or service. For that, cost accounting is needed. Any questions up to this? Only one question came up, which is what is GL account, which I tried to explain. So any other questions? Another important accounting term and concept is departmental accounting. There are companies which have got several divisions or several departments which are dealing with maybe different kinds of activities or products. So departmental accounting involves separating operating divisions into their own sub-entities on the income statement, showing individual income, expenses and net profit by entity. So the operating divisions are divided into various. I am the replacement teacher because your regular faculty won't be available today, so I am not going to teach you in the next session possibly. Since it's not available today, I'll be taking your classes. Is that okay? Shivash? I am your teacher for today. So when a company has got several divisions or departments, then the income statement, individual income, expenses, net profit for each of these divisions or departments can be separately accounted for. That is called departmental accounting. Let's take the case of a company like L&T Limited. Say it has got engineering division, it has got construction division, it has got project division. So various divisions are within this company L&T Limited. For each of these divisions, now each of the division is handling one kind of product or services, and for each of the division, the income of that division, expenses relating to that division, net profit relating to that division can be accounted for, and the whole can be combined to create the financial statements for the company as a whole. This is called departmental accounting. So the idea behind departmental accounting is to determine the profit of each sub-entities within the operating divisions, determine profit, whether they are profitably run or not, how much profit they are making and all that. That is the concept of departmental accounting. Some of the companies which have got several divisions or several business lines, they resort to also departmental accounting to know whether each business line, how much profit each business line or division is generating and all that. And another important term is liquid assets. I hope you all understand it, but still let me try to clear it. Cash or other property or assets which is easily convertible into cash. So cash is itself cash. Cash and bank balance in the current account with the bank is also equivalent of cash. So living cash and bank balance, there can be also other assets which can be easily converted into cash. So these are called liquid assets. So basically cash or other assets of the business which are readily convertible into cash are called liquid assets. Like fixed assets are not liquid assets. They can be converted into cash. Fixed assets can also be sold, but they cannot be readily sold. It takes time to sell fixed assets. So they cannot be considered liquid assets. Debtors, again it depends. See, debtors, if the debtors is, if your terms of sales is, let's say, 90 days, if you are selling on credit and the credit period is 90 days, you have to wait for 90 days to get it converted into liquid assets, into cash. But yes, normally debtors is considered a part of the liquid asset of a business. So when we talk about liquid assets, we also include debtors. That basically depends on, you have to look in the context of the business. Debtors could be long-term debtors, it could be short-term debtors. So basically one has to, normally we look for debtors for short-term period. That means that the credit sales have been made for shorter periods, then this can be considered as liquid assets. So it is specific, basically case-to-case basis you have to decide. For a particular business, what are the liquid assets? You have to know the business and then decides what could be, what are really readily convertible to cash and what are not. Retained earnings, I came across that term earlier also, retained earnings. This amount of net profit retained in the business. So the company which earns profit at the end of the year, now the whole part of the profit can be retained in the business, it may not be distributed to the shareholders or the owners of the business. Because the company constantly needs funds to grow its business. So one of the sources of funds for growing the business is the profit earned. That is called internally generated funds. Profit earned is an internally generated funds. So the internally generated funds is one of the source of funds which are needed for growing the business. Each company tries to grow. So when a company tries to grow, it needs more funds. When it tries to grow its business, it will need more funds. So one of the sources of the funds could be the profit that a company has earned from its operations. Now at the end of the financial year, when the company determines its profits, it has also to make a decision how much of the profit it will retain in the business and how much profit will be distributed to the shareholders or the owners. So amount of the net profit which is retained in the business and not paid out to the shareholders over the life of the business, that is accumulated in the retained earnings account. So giving an example, a company in the first year earns a profit of, let's say, 50 lakhs, out of which it retains 30 lakhs in the business. Second year, so 30 lakhs is the retained earnings. At the end of first year, so year 1 profit is 50 lakhs, out of which 30 lakhs retained. Company doesn't pay out this to the shareholders. 30 lakhs is retained. So at the end of the first year, the retained earnings is 30 lakhs. Year 2, company earns a profit of, let's say, 70 lakhs, out of which 40 lakhs is retained. So what is the total retained earnings at the end of the second year? 70 lakhs. So retained earnings account will show a balance of 70 lakhs. Third year, supposing the company earns 100 lakhs profit and retains 60 lakhs, then the retained earning balance will be 130 lakhs. So retained earnings is the amount of net profit retained and not paid out to the shareholders over the life of the business. That is what we call retained earnings. It appears in the balance sheet as a component of equity. In the balance sheet, you will find retained earnings as a component of equity or shareholder funds on the liability side. Either it will be named as retained earnings account or profit and loss account. It will go either one of the names retained earnings or profit and loss account. Retained earnings purpose is basically the company needs money to grow his business. This company, look at, the company needs money to further grow its business, needs more capital to grow its business. Now, one of the source of capital could be the profit which has been earned by the company. That is the internally generated funds. Funds which have been generated through the operations of the business. So, company can decide that, okay, who has a claim on the profit? Normally the shareholders will have a claim on the profit. The owners only has a claim on this profit of 50 lakhs. Now the company needs money to grow its business, so it decides that out of the 50 lakhs, we will keep 30 lakhs in the business and distribute 20 lakhs to the shareholders. That 30 lakhs will be used by the business or the company to grow its business further. So the purpose of retained earning is to get additional capital for growing the business. Get additional capital through internal sources for growing the business. The other option for the company for getting the additional capital would have been to ask the shareholders to give more capital. Instead of asking the shareholders to provide more capital, what they are doing, out of the profit of 50 lakhs earned, which actually belongs to the shareholders, they are keeping 30 lakhs in the business and distributing 20 lakhs to the shareholders as dividend. So the purpose of retained earning, when a company retains a part of the profit, the very purpose is to use that money as additional capital needed to grow the business. Is that clear or not clear? Somebody asked a question, what is the purpose? So I am answering that question. I hope the answer is clear to you. I missed your name because your name is... Okay, thank you. Then statement of account. This is something we are also familiar with. Basically, summary of amounts owed to a vendor, lender, etc. That is called statement of account. If the company owes money to a supplier or a vendor, then the accounts that is maintained in the name of the vendor, summary of those accounts basically called statement of account. So statement of account will show statement of receivables, statement of payable account payable. What it will show? What is the amount owed to various vendors. Statement of account receivable will show, yes, debtor sir's class, but debtor sir is taking, I am taking. He is not available today. So summary of amounts owed to a vendor or to a lender, these are called statements of accounts. So summary of account receivable, you can have a statement of account receivable, you can have a statement of account payables. So these are called statement of accounts. It shows the amounts owed to a vendor or lender, etc. Then we come to what we call subsidiary accounts. Subsidiary accounts are totaled on the financial statement under the master account. So a master account will have several subsidiary accounts. Like example of cash. Cash is a master account. Cash means cash and bank balance. Cash means physical cash kept in the business, available, held in the business, and also balances in current account in various banks. So under the cash account, there will be various subsidiary accounts, cash in ABC Bank. That means an account maintained with ABC Bank, how much balance is there? Cash in SBI. So how much balance is there in the current account with SBI? So under the cash account is basically comprising of various subsidiary accounts. So when you want to arrive at the cash balance in the cash account, you have to add up the balances in the various subsidiary accounts to arrive at the balance under the master account cash. So you have to subtotal the balances. Supposing a company maintains current accounts with 3 banks. It also holds some physical cash. So basically cash, when you're trying to determine total amount of cash available with the company, that is on the cash account, how much balance should be reflected, we have to subtotal the balances in all these 3 accounts, current accounts with 3 different banks, and also the physical cash that is held in the business. So then we'll get the balance of the master account cash. So that is the concept of subsidiary account. Similarly, accounts payables. This is the master account payable. Now under account payable there can be various subsidiary accounts. So supposing there are 3 suppliers who are supplying on credit basis. So the amount owed to supplier A will be reflected in one subsidiary account. Amount owed to supplier B will be reflected in another subsidiary account, and amount owed to supplier C will be reflected in another subsidiary account. So when we are determining what is the balance under the master account called account payable, we have to subtotal all this balance in all these 3 accounts to arrive at the balance of the account payable, which is a master account. So each master account can have several subsidiary accounts, and these are basically nothing but these are linked to basically the master account. So you have to, every time you want to determine the balance in the master account, you have to total the balances of all the subsidiary accounts which are related to that master account. Then we come to another term called supplies. These are basically sundry assets which are purchased by the business for consumption by the entity. Entity is going to consume these assets over a period of time, like stationery. Stationery may comprise papers for printing, papers for photocopying, it can paints. So these things, what happen when the business is operating, these things are going to be consumed over a period of time. So from time to time company purchases these things and then goes on using it, and again when the stock becomes low they again purchase. So these are called supplies. So these are sundry assets purchased to be consumed by the entity, for example stationery, tools, etc. So when you come across the word supplies, it normally means sundry assets purchased by the business for their own consumption, like stationery, tools, etc. Another term we'll come across is treasury stock. Now a company issues shares to the shareholders. Normally company to raise capital issues shares to the shareholders. Various shareholders, they hold company shares. Sometimes the company may start buying back the shares from the shareholders. This is called buyback of shares. Company can issue shares to the shareholders. They can also buy back those shares from the willing shareholders, people who are willing to sell it back to the company. That is called buyback of shares. When shares are bought back from the shareholders under a buyback program, these shares are held as treasury stock. These shares will be reflected, the shares which have been bought back from the shareholders, from the willing shareholders, will be reflected in the balance sheet as treasury stock. Just to give an example, right now, National Hydroelectric Power Corporation NHPC Limited, I do not know whether you are aware of the name of this public sector company. NHPC Limited, National Hydroelectric Power Corporation Limited, this is a public sector power generating company which produces hydroelectricity. Now this company shares, of course, Government of India owns the majority shares here because it's a public sector company. But there are also a large number of other shareholders, retail shareholders, institutional shareholders, etc. So the shares of the company are listed in a stock exchange and these are held by public as well as government. Now this company has started recently on 3rd of March. They have made an offer, buyback offer to the shareholders. Any willing shareholder can tender his shares for the buyback. They are fixed a price, at which price they will buy back the shares. Now this buyback offer is open up to 17th of March. It is currently going on. From 3rd of March it has started, it will be open for 2 weeks. It closes on 17th of March. So any person who is holding shares of NHPC Limited and wants to sell those shares to the company itself, they can respond to the buyback offer by tendering their shares to the company, and the company has a program to buy back a particular number of shares. They will buy back so many shares. So they will not buy back more than that. So based on that, whoever is a holder of the shareholder and responds to the buyback offer and tenders his shares for buyback, company may buy back. Under the offer, company will buy back those shares up to that number, at a particular number of shares they are willing to buy back now. So those shares, after they are bought back from the shareholders, will be held as treasury stock. So in NHPC Limited's balance sheet, these will appear, those shares which have been bought back from the shareholders will appear as treasury stock. So treasury stock means shares purchased by the entity or the company from the shareholders, reducing the shareholder equity. When the company buys back the shares from the shareholders' equity will naturally get reduced by the amount of treasury stock. So this is the concept of treasury stock. Any question? Buyback of shares is not a very frequent phenomenon. Company does it from time to time. They may make an offer to the shareholders to buy back their shares, but this is not very frequent kind of a thing. It happens occasionally. But companies are allowed to buy back their own shares from the willing shareholders. Somebody doesn't want to sell, no problem, he can hold his shares. Somebody wants to sell the shares to the company, they can sell it under the buyback offer, as long as the buyback offer remains open. Now another term is write down or write off. It means an accounting entry that reduces the value of an asset due to an impairment of that asset. So an accounting entry is passed to reduce the value of an asset because the asset has been impaired. Or the account receivable from the bankrupt customer. If the customer has become bankrupt, he has no capacity to repay, then the account receivable from the bankrupt customer has no value, he won't be able to repay. If a company has account receivable against a particular customer and the customer goes bankrupt, that means he is he goes to the court and declares that he is not, and court also adjusts that he has no capacity to repay, then the company won't be able to recover that money from the customer. So what will happen to that account receivable? The account receivable entry has to be written off or written down. If it is to be completely, if it is not recoverable, then it has to be written off. If it is a part of that is recoverable, then it has to be written down. So write down or write off. Write off means the entire thing has to be, the accounting entry will be passed so that the asset value will be reduced to zero. That is write off. Write down will be basically, impairment means, you have not come across the word impairment. Impairment means basically when the value of an asset goes down. The realizable value of the fair value of the asset or the realizable value of the asset is less than the book value, we call it impairment. The asset is impaired. No, depreciation is not a write down. Depreciation is not due to impairment. Please understand. Depreciation is a charge for usage of the fixed asset. It is not due to impairment. Depreciation we do not consider as a write down. But supposing the company is holding some inventory. Supposing the company is holding some inventory and some of the inventory got damaged. So that is an impairment. So company is holding the inventory value is 50 lakhs of rupees. As per the books of accounts, the inventory is valued at 50 lakhs of rupees. Now when you physically look at the inventory, some of the inventory is damaged and you estimate that the inventory, if it is sold in the market, will get you only 30 lakhs. That is impairment. Because the realizable value or the fair value of the inventory is less than the book value of the inventory. That is the inventory has been impaired. There is an impairment of the asset. So impairment means basically when the value of an asset, a realizable value of an asset or fair value of an asset is less than its book value, then we say the asset is impaired. Is that clear? Part from Delhi South Extension is asking about the meaning of impairment. Depreciation, when you depreciate, it's according to a policy. We are reducing, basically, we are charging for the usage of the fixed asset. We are basically, this is a financial charge for usage of the fixed asset that we are trying to recover. Because a fixed asset has a limited life. All fixed assets except land, all have got limited life, useful life. Except land. Land has got unlimited, land has got no limitation on its useful life. So that's why land is not subject to depreciation. But since all other fixed assets have got limited useful or economic life, and we are using the fixed assets for the purpose of the business, for running the business, they are essential for running the business of the operations. So we should charge for the usage of fixed assets over the economic life of the asset. That is depreciation. So depreciation is not due to an impairment, it is not a write down. Impairment means simply an asset is reflected at a particular value in the books of accounts, but the realizable value or the market value of the asset is less than the book value. Then we say the asset is impaired. So when an asset is impaired, what we do? We have to ultimately reflect the realizable or the market value of the asset. We have to reduce the book value and basically show the asset at the realizable or market value. So we can do it by writing down. So you have to pass an accounting entry which will reduce the value of the asset, book value of the asset, to the realizable or the market value of the asset. So the inventory is valued at 50 lakhs in the books of accounts and the realizable value or the market value of the inventory is only 30 lakhs. Then you have to pass an accounting entry to write down the value of the inventory from 50 lakhs to 30 lakhs. That is write down. So write down and write off, these words are used. Write off means if the inventory has no value, supposing you look at the inventory and found it has no value, it cannot be sold in the market. Then you have to write off the entire thing. So entire 50 lakhs have to be written off. So write down or write off is, if the write down is partial, if the reduction in the value is partial, then we call it write down. If it is whole, then we call it write off. That is the only difference. Is that clear? So we discussed about some of the accounting concepts, conventions, and also some of the important terms. So next thing we'll talk about is components of financial statements. So when you talk about financial statement, what does financial statement comprise of? So we talk about the components of financial statement. We'll try to first understand what is the complete accounting cycle in a business from record till report. So recording of transactions till reporting the financial results. Record till report, that means recording of the transactions on a day-to-day basis, and finally preparing the financial statements or reporting the financial performance of the business. So what is the complete accounting cycle in a business from the point of recording of transactions till the generation of the financial reports? So what is the complete accounting cycle? Number one, this will try to understand. We will try to understand the flow of transactions in finance and accounting till reporting, and the source documents. We will talk about source documents, GL, chart of accounts, and subsidiary ledger. This gives you an idea about, the diagram on your screen gives an idea about accounting process flow, particularly in a manual kind of a setup. The traditional or conventional approach of the cycle from recording of transaction. So from recording of transaction, how the cycle goes on. This is traditional and the conventional approach of the cycle from recording of transaction. First is the happening of a monetary transaction or event. The first one shows the happening of a monetary transaction or event. So monetary transaction or event takes place when source documents will be generated. So supposing a person, a buyer comes to buy a product or services. That is the happening of that monetary transaction or event. That is when the transaction or event starts. A buyer comes to buy a product. So what will be the source document that will be generated when the buyer comes to buy a product? He selects the product. A invoice will be generated. That is the source document. A sales invoice will be generated when the buyer is going to buy the product. That is the source document. The source document will be, now buyer pays the money. Now a copy of the sales invoice will be written by the business, that will be analyzed first. So all the sales which have taken place during the day, sales invoices have been generated. This will be basically analyzed by somebody. This will be seen, basically looked at by somebody who is recording the transactions. So he will record the transactions on the based on the invoices which have been generated when sales took place. So the accountant, by sales invoices, the accountant is not directly involved in the selling process. The people in the counter, the salesmen in the counter, they are selling products and services. So when they sell the products and services, they generate sales invoices. What is the question from Devali? I do not understand what is bill of sales you are talking about. Okay, I think it's almost similar unless something else is meant. Normal term is sales invoice. Now bill has got a different meaning altogether. Bill can be bill of exchange. So I am not talking of bill of exchange here, I am just talking of the bill invoice that is generated. Supposing the buyer is paying cash at the counter. You go to any shop and sell and buy goods. So you are given a cash memo. Cash memo is the equivalent of the sales invoice. So you get the cash memo, you pay the money and buy the goods. Now at the end of the day, these transactions are being recorded, being done at the sales counter. So all these sales invoices, these are called source documents, this will go to the accountant. A person who is maintaining the records of transaction will go to him. So the accountant will analyze those sales invoices and then will record the transactions. So transaction recording starts here. So it is based on the source documents. So he will analyze the source documents, verify it, and then record it for the first time in the subsidiary books. He may not record all these things in the main book, in the GF. So there are various subsidiary books maintained for the purpose. So this will be recorded in the subsidiary accounts or subsidiary books. Then from the subsidiary books the total will be posted to the main general ledger account. Just to give an example, supposing during a day 3 sales have been made to 3 different buyers, all on credit. So these are account receivable. 3 sales have been made. There are 3 sales invoices. And supposing all 3 sales have been made, just for example, to 3 buyers on credit, they will pay after a certain period of time, agreed period of time. Now the sales invoices will be sent, when it goes to the accountant, he will analyze, okay, this sales has been made to A, this sales has been made to B on credit terms, and this sales have been made to C on credit terms. So in the subsidiary, he has an account, subsidiary ledger, or subsidiary books of accounts where accounts are maintained in the name of A, B and C. So in those accounts, he will record those transactions. Sales account transaction will be recorded in the sales account and also in the account receivable accounts maintained in the subsidiary books for A in the name of A, B and C. Now the total of A, B and C will be entered in the GL. GL, there is a master account called account receivable, there it will be entered. So basically the accountant will analyze the source document, verify it, if necessary he has the power to approve it, he will approve it, and then records for the first time in the subsidiary books, then posted to the general ledger. Then he will prepare what is called trial balance, so to know that whether the arithmetic accuracy of the balances, just to verify the arithmetic accuracy of the balances. This is, remember, this is a traditional and conventional approach, so everything will be done manually, so he will prepare trial balance. And this will be done till the reporting period comes, till the reporting day comes. This will be done every day, this way. And on the reporting day, certain adjustments will be made, and then the financial statements will be prepared. And once the financial statements are prepared, they will be now presented to various users in the form of annual report. This is the cycle from recording to reporting. The accounting cycle from recording to reporting, we can see that diagrammatically transactions, source documents are created as a result of transactions which are happening. These are analyzed, and then the transactions are recorded, posted to the ledger, maybe to the subsidiary ledger, and first to the subsidiary ledger and then to the general ledger. Then trial balance will be prepared, and when the reporting time for reporting comes, the preparation of the financial statement or closing of the books comes, then financial statements will be prepared and then reported in the form of annual reports to the users. So this is the overall cycle from recording to reporting. So the sequence of recording a transaction is given diagrammatically on your screen. We must have a chart of accounts or musters. Without the chart of accounts and musters, you do not know where the transactions are going to, which of the accounts are available and where the transactions are going to be recorded. So, must have a chart of accounts or musters. Basically, it is nothing but the list of accounts and the account numbers. Then transactions take place, they happen. We have documents or source documents are made, documentation is made for the transaction or source documents are created. Then journalizing is done in subsidiary books. Then posting is made to the main ledger, general ledger. Then trial balance is cast, and ultimately financial statements are prepared at the time of reporting or preparing the annual reports. So this is the basically sequence of recording a transaction. What are the various kind of source documents? We have been talking about source documents. I just gave you one example, sales invoice. So various kinds of source documents could be like say checks. Checks received from the customers, checks paid out to customer, this could be source documents. Checks drawn on banks. Credit card statements. Statement received from the credit card provider, this can be source documents. Account payable invoices. Purchase orders. Bank statements. Don't bother about checks at spelling, this is American spelling. You should also sometimes get used to American spelling. Americans don't spelling check as C-H-E-Q-U-E. They simply okay. That is the correct spelling, only thing it's the American spelling. Then bank statements, sales invoices, these are various source documents. Some of us participants on the previous slide, okay, I'll go back to the previous slide for them. Just a minute. I hope you have finished with the previous slide. Shivani and Divakar. Shivangi and Divakar. Okay. So can I move to the next slide? Which is basically when describing the source documents. So various kinds of source documents could be checks, could be credit card statements, account payable invoices, purchase orders, bank statements, sales invoices. This could be used as source documents. Source document is nothing but the verifiable evidence of supporting document. When you record a transaction, there must be some verifiable evidence or supporting document for recording the transaction. Otherwise, how do you know the transaction has happened or not? So it is a supporting document which shows that such a transaction has happened, and so the transaction can be recorded. So source document is the verifiable evidence or supporting document with which transactions are recorded or posted for the first time. Now source document will depend on the nature of transaction. What source document for which transaction, that depends on the nature of transaction. So source document will always depend upon the transaction, like vendor invoice for expense posting, bank statement for banking transactions, like bank charges or interest. AP invoice means account payable invoice. AP stands for account payable. Please get used to some of the abbreviations. AR means account receivable. So whenever you come across the word AP or AR in accountancy, please understand the meaning as account payable or account receivable. Is that clear, Faisal? So account payable invoice. That means the supplier has supplied goods to you, and he created an invoice on you when he supplied goods. That is the account payable invoice. He has sold goods on credit. You have to pay him after the agreed period. That's the account payable invoice. Is that clear, Faisal? From Borivali. I don't get his response. Okay, thank you. Thank you, Faisal. So source documents, checks means you don't use banking checks. Don't you use checks when you want to withdraw money from the bank account? Do you have a bank account? It's an American spelling, so don't get confused with the spelling. It is same as CHEQUE, check. Americans spell a few things differently. Okay, we have to know that. So for bank statement for banking transactions, suppose bank has recovered some charges, or bank has charged interest on your account. So your bank statement will reflect that. So how do you account for the interest which has been charged by the bank, which has been paid to the bank? So for recording that transaction of interest payment to the bank, your bank statement will be the source document, or any approved voucher. So source documents will depend on the nature of transaction. The same source document doesn't apply for all kinds of transactions. Depending on the kind of transaction, source documents can be different. But source documents are important evidential record. These are usually used in audits. So auditors will basically, when they audit the accounts, they will look at the source document to know whether the transaction is genuine or not. Whether the transaction recorded is actually the transaction happened or not. To know that, the auditors will look at the source document. They will ask you to produce the source document. So source documents is something which has to be preserved. It has to be preserved for verification by the auditor subsequent. That is a supporting document. It's a evidence. It's basically evidence that this transaction happened. Okay, it supports. Okay, we'll have a small break at this point of time, and then we'll continue. after the break. Now, earlier I was talking about the traditional or conventional approach. Under that, what is the accounting cycle? Now, if you look at the IT environment today, ERP or IT environment, because most of the organizations today have using this kind of environment, they are not doing maintaining their books of accounts manually, but they are using various kinds of softwares, accounting softwares for or ERP softwares for recording purpose. In such an environment, how does it look like? So the steps involved in the accounting cycle in a ERP or IT environment: transactions are first analyzed, sorted, scanned, and then entered. Transactions means the source documents will be analyzed, they will be sorted, then they will be scanned, and then entered. Data can be processed by the users in the ERP system. So that data processing can be done by the various users of the ERP system. They can process data. Preliminary reports will be analyzed, and if necessary, adjustments will be prepared and entered in the computer. Then financial statements will be printed and distributed. The reports will be analyzed and interpreted for decision-making purpose. So in the ERP or the IT environment, things are done a little differently, because here we have the help of a software which can do the processing needed for whatever processing is needed for the purpose of accounting, for purpose of generating various reports, etc. So in a ERP or IT environment, things are done differently, and when you go to work, you will find mostly you will be working on an ERP or IT environment, and this will be the steps involved in the accounting cycle, where transactions will be first analyzed, sorted, scanned, and then entered in the software. Data will be processed by the users in the ERP system to look at preliminary reports, which will be analyzed, and adjustments, if necessary, will be prepared and again entered in the system. Then financial system will generate financial statements, they will be printed and distributed. Various kinds of reports can be prepared, and this will be analyzed and interpreted for the purpose of decision making. That is how it is done in a IT-enabled environment. That is the accounting cycle. Record to report. So if you look at the accounting transaction flow in the ERP system, various journal entries are done, posting of journal entries are done, then these postings have, there is an interface with various subsidiary ledger, account receivable ledger, account payable ledgers, fixed assets ledger, subsidiary ledgers. Then posting is made in the general ledger, where assets, expenses, income and liabilities are recorded. Okay, you want the previous slide? Okay, just a minute. I'll go back to the previous slide, then I'll come back to this. Okay. Take your time, go through the slide, and tell me when you are finished. ERP is Enterprise Resource Planning. It's a kind of a software. Most organizations use it today. ERP software. Enterprise Resource Planning. That's a full form of ERP. Okay, so I can move to the next slide. So in a ERP system or IT environment, once the journal entries are done, journal entries are posted, they will get through interface, they will get posted through various subsidiary ledgers, and from the subsidiary ledgers, posting will be made into the general ledgers. General ledgers will basically reflect accounts which represents assets, expenses, incomes or liabilities. Then they will be summarized and trial balancing will be done. At the time of reporting, profit and loss account will be generated, balance sheet will be generated, various kind of financial reports will be generated by the system. That is how the accounting cycle, recording to reporting. Recording starts with journal entries getting posted and the reporting with generation of profit and loss account, balance sheet, etc. by the system. So in a computerized or ERP environment, general ledger or chart of accounts forms basically the core database that carries all the reporting ledgers. General ledger will get transaction posting from either direct posting of the journal entries or through the sub ledger like AR, ARP, fixed assets, inventory ledger, etc. through interface. From general ledger, trial balance and further financial statements are derived. That is how it is done in a ERP environment. And this is the kind of environment you will be coming across when you start working for organizations. You will come across this kind of environment, whether it's in the bank or some of the organizations you are working. You will be faced with this kind of an environment where basically entering the transactions in the system is the main job you will be doing, and looking at the various preliminary reports which are generated by the system, correction of errors, if any, so entries for correction of errors, etc. can be done, and basically the system will generate the various reports at the end of the reporting period. So life will be much more easier in the ERP environment because computer is there to help you. Now the concept of general ledger and subsidiary ledger accounting, basically if you look at general ledger is basically the master accounts only are maintained in the general ledger. These are accounts relating to assets, liabilities, incomes and expenses. So GL is a part of the main chart of the accounts. So when you have a list of the accounts, various accounts which are maintained, GL is basically a part of the main list of the accounts. GL balances will make up the financial statement, that is trial balance and balance sheet. Balances of the various GL accounts, they will basically make up various kind of financial statements, including trial balancing and the balance sheet. Now there are certain control accounts, GL control accounts these are called. They receive the aggregate posting of the subsidiary ledger activity, like account receivable is a control account. Under account receivable it's a GL control account. Under account receivable there will be subsidiary ledgers where the accounts of individual buyers will be maintained. Accounts of the individual debtors will be maintained. So AR is basically a control account, GL control account. It's a main account, but under that there will be subsidiary ledger, and in the subsidiary books there will be individual accounts maintained in the name of the individual buyers or the debtors. Subsidiary ledger basically captures and maintains all the details of the business transaction. So the detailed business transaction may not be reflected in the GL at all. The detailed business transactions will be actually entered in the subsidiary ledger. The SL master will identify the unit level and captures all details, for example, customers for a year. So SL master, supposing the subsidiary ledger for account receivable, the subsidiary ledger master, that is a chart of the accounts which are there in the subsidiary ledger, that will basically all details like customers for a year, all will be recorded in the subsidiary ledger. So in the account receivable subsidiary ledger, all the parties to whom sales have been made on credit, an account will be maintained for each of those parties, each of the buyers. Account number will be given. So that the sale master will show those list of the account receivable, those accounts under the account receivable subsidiary ledger with the account numbers of various debtors. Similarly for the account payable, etc. So basically subsidiary ledger provides the lower level breakup. Subsidiary ledger basically provides the lower level breakup and detailing of the transaction posted. Like account receivable for the customers, account receivable subsidiary ledger for the customers, account payable subsidiary ledger for the vendors. So a subsidiary ledger will contain the details to support a general ledger control account. So all the details will be available in the subsidiary ledger, only that aggregated amount will be appearing in the general ledger control account. So the aggregate account receivable will appear, that number will appear in the account receivable control account in the general ledger. The details of the receivables from individual customers will be available in the subsidiary ledger. Like the subsidiary ledger for, another example could be subsidiary ledger for account receivable. It contains all the information on each of the credit sales to customers, each customer's remittance, return of merchandise, discounts, and so on. With these details in the subsidiary ledger, the account receivable account in the general ledger can be a control account. As a control account, it will simply report the aggregate amounts of the account receivable activity. So we have an account receivable control account in the general ledger to which the account receivable subsidiary ledger is linked. So in the account receivable subsidiary ledger, there are accounts in the name of various customers, and each of the accounts will reflect how much sales have been made to the customer, how much payment he has made, if any discounts have been provided to him, if any goods have been returned by him. All these details will be reflected in the subsidiary ledger account of that particular customer. In the GL control account of account receivable, we will only see the aggregated position of account receivables for all customers. We will not see the details in the GL. The details will be, a detailed breakup will be available only in the subsidiary ledger. So if you want to look at a particular customer's transaction, we have to go to the subsidiary ledger and look at his account maintained in the subsidiary ledger. So the entire account receivable activity aggregated position will be reflected in the general ledger, but for each customer, activities relating to each customer, transactions relating to each customer will be seen in the subsidiary ledger for the account receivable. I hope the concept is clear to you. So this is the concept of accounting process flow from recording to reporting under the traditional or conventional approach or under the ERP or IT system. So any questions? Any doubts? Now we'll talk about a few basic things, how a transaction is generalized under the modern as well as traditional approaches, because we are talking of generalizing a transaction, that is the recording of the transaction. We will talk about the rules of debit and credit according to both the approaches. We will also apply the generalization concept to various scenarios, complex closing and adjusting entries. We will talk about accruals and deferrals in the accrual basis of accounting, and the fundamentals and the terms used in finance and accounting. So this is basically for most of you who are a prior background in bookkeeping or financial accounting. Some of these things will be already known to you. Just to refresh your memory, we'll go through these things. So what is generalization? It is the process of recording all business transactions and events for the first time in the books of original entry. So it is the first step in the record to report process. For the first time when a business transaction is recorded in the books of original entry, we call it generalization. That book is called journal. So books of original entry is basically books in which a transaction is recorded for the first time from a source document. So you have the source document, sales invoice. You have to record the transaction using that source document. You have a source document like a check. You have a source document like a bank statement. So using that source document, you have to enter the transaction or record the transaction in the books of original entry for the first time. Before that, it has not been recorded in the books of accounts. So generalization is the first step in the record to reporting process. So journal entry is basically an entry into a journal. It is one of the books of the original entry is journal. So journal entry is nothing but entry into a journal, entering the transaction in a journal. So a journal is basically one of the basic books of original entry in which transactions are originally recorded in a chronological day-to-day order according to the principles of double entry system. So it's a book of original entry where transactions are recorded for the first time in a chronological fashion. That means today's transactions will be recorded in the chronological way. Tomorrow's transactions will be recorded. So every day's transactions will get recorded in the journal, but in a chronological fashion. You cannot record a transaction of yesterday after a transaction of today. All transactions of yesterday should first be recorded, then transactions of today will be recorded, like that. And the principle to be followed in recording the transaction is called the principle of double entry system of bookkeeping. Now there are some, when you talk about the traditional approach, there are some classification of the accounts and posting rules we have to follow. The principle of double entry system of bookkeeping requires that we have to classify accounts. Various accounts can be classified in different kinds of types, and then certain posting rules should be followed for recording the transactions. So all business transactions, if you look at any business transaction, it can be broadly classified into three categories. First category is a transaction relating to a person. So when you sell goods to a buyer, the transaction relates to the buyer. In the bank, when you take deposit from a customer, the transaction relates to that customer. So relating to a person. So there will be some business transactions which will be related to a person. Some business transactions will be related to property. Like when I buy, you want the previous slide again? Okay. So I will leave the previous slide for a few minutes because somebody wants it to wants to go through it once more, or didn't have enough time. So I'll go a little slow, I think. If it is creating a problem, I'll go a little slower. Leave the slides for a somewhat longer period on the screen, if that helps you. So let me know when you are done. Shubham Girindal. Are you done? So can I move to the next slide, Shubham? That your regular faculty will let you know. About your cycle test 1, your regular faculty will let you know. I am not a regular faculty, so I have no idea at this moment. I am taking your classes for 1 day only. So when Mr. Debraj Mukherjee comes back, ask him the question. Or you can check from your center. Okay, I hope I can now move on. Although I am not getting any response from Shubham anymore. So if you look at various kinds of business transactions, there are certain business transactions which relate to only a person. Transaction is with another person. There are business transactions which are related to property, like somebody purchases a fixed asset, somebody purchases land. So this transaction is relating to a property. Buying of land, buying of an asset is basically related to a property. And there are certain other transactions which are related to income and expenses. A company pays salary to its employees. So payment of salary is an expense for the company or the business. So transactions can be related to expenses, transactions can be related to property, transactions can be related to a person. So all business transactions can be classified or thought of either relating to property or to person or relating to income or expenses. Sale of goods related to income. A transaction involving sale of goods is related to income. So these are the 3 things transactions can be related to, and based thereon we have 3 classes of accounts. For recording of business transactions, we have 3 classes of accounts. One we call personal accounts, where transactions relating to a person will be recorded. One we have real accounts, where transactions relating to property will be recorded. And we have nominal accounts, where transactions relating to income or expenses will be recorded. Now personal accounts means accounts in the name of a person. So all transactions entered with that person will be recorded in that account. Now person doesn't mean only a biological person. Please understand. It need not be a biological person. Even a company will be treated as a person. Another company will be treated as a person. Bank will be treated as a person. So any other organization can be treated as a person, any entity, whether it's biological entity or artificial entity, it can be treated as a person. So real and nominal accounts, since they do not involve, since they are not related to persons, they are also called, together they are also called impersonal accounts. So basically we can broadly classify accounts into two types, personal accounts and impersonal accounts. And within this particular category, that is type impersonal accounts, we have two types of accounts. We call them real accounts and nominal accounts. So first we have personal accounts and impersonal accounts, two categories or two types. And within that particular category, impersonal accounts, we have again two types or two categories, that is real accounts and nominal accounts. So personal accounts are accounts that show dealings with persons. So these accounts will reflect transactions with persons. Persons are categorized again into individuals, for example creditor, debtors. So the accounts will be maintained in the name of the creditors or the debtors. Name can be X, Y, Z, etc. Personal accounts can also be categorized into representative. So here it could be prepaid expenses, outstanding expenses, accrued income, etc. This will be also, they are representing prepaid expenses paid to somebody. So they represent some person actually. Prepaid expenses to somebody. To prepaid expenses to prepaid insurance premium to the insurance company. So there are representatives, could be person. And it could be artificial persons like X Limited, bank, firm, etc. So the personal accounts again can be categorized into accounts in the name of individuals, representatives, although no name of individual is given here, but basically the payment or the transaction has been entered with some person and this transaction represents those persons. Prepaid expenses to various or prepaid wages to the various employees. It's a prepaid expense. Expenses, wages paid in advance to various employees, it's a part of prepaid expenses. Then we have artificial persons like X Limited, Y Limited, State Bank of India, like that. Real accounts are basically accounts relating to properties or assets other than banks and debtors. Balance held in the bank account is an asset, but that is not a real account. Or account receivable from the debtors is not taken as real account. So all assets, properties or assets, accounts relating to the properties or assets like fixed assets, inventory, these are all real accounts. Cash, furniture. So accounts relating to properties or assets other than banks and debtors are real accounts. Banks and debtors will be again personal accounts. Like cash account, furniture account, machinery account, building account, these are all examples of real accounts. Real things, they represent properties or assets. Like cash account, physical cash held in the business. Furniture account, various furniture which are used in the business or in the office. Machinery account, various machineries which are used for the purpose of running the business. Building account, building owned by the business, things like that. So these are real accounts. These are reflected through real accounts. So we looked at personal accounts, real accounts, and then the third type of account, that is nominal accounts. These are accounts relating to expenses, losses, incomes and gains. Examples: wages account, salaries account, commission received account, interest received account, interest paid account, rent account, sales account, purchase account. These are all relating to expenses, losses, incomes and gains. Now, having understood that there are three types of accounts we are dealing with, we have to understand what are the posting rules when you record a transaction, when you journalize a transaction, what are the posting rules for each of those accounts. These are called golden rules of accounting. So, two things we need to understand when a transaction involving the double entry system of bookkeeping. Every transaction will require recording one part of the transaction as a debit in one account and credit in another account. That is the basically double entry system of bookkeeping. Every transaction will have two entries. An account must be debited and an account must be credited. That is the basic principle of double entry system of bookkeeping. Now, which account to be debited and which account to be credited, basically we have to understand which of the accounts are involved in which of the two accounts, what are the types of the accounts which are involved in this transaction, in a particular transaction, their types, and then use the posting rules to understand which account should be debited and which account should be credited. So the accounting rules for each class of accounts, very simple, but something you have to always remember. Personal accounts always debit the receiver and credit the giver. If it is a personal account and the person received, then debit the receiver's account, debit the personal account. If the person gave, credit the account. Real accounts debit what comes in and credit what goes out. If cash comes in, then the cash account will be debited. If cash goes out, cash account will be credited. And nominal accounts, the rule is all expenses and losses should be debited in a nominal account, like salary is paid. It's an expense. The salary account should be debited. And credit income and gains. Supposing sales have been made. So income has been generated, so sales account should be credited. So for any transaction which is taking place, you have to understand which two accounts are involved in the transaction, what are their types, and then follow these accounting rules to determine or decide which account should be debited and which account should be credited. So we look at some of the journal entries. And try to see what type of accounts are involved here for such a transaction, for each of the transaction, which of the accounts involved, and and how they have to be, which account should be debited with the amount and which should be credited. The first one is insurance premium of 3,600 is paid for 12 months. So insurance premium is paid. 3,600 is paid for 12 months. 300 rupees per month is the insurance premium. 7 months relate to the next accounting year. Assuming that the payment is made in cash. We are assuming that the payment is made in cash. So which accounts are involved? Number one. For the first example, which accounts are involved? One account is, of course, cash. It's a real account. So cash is involved. Which other accounts are involved? Cash has been paid towards insurance premium. So what are the accounts involved? One account, of course, is cash. Which other account or accounts are involved? One is insurance expense. But remember, 3,600 has been paid, out of which 7 months premium is relating to the next accounting year. Only 5 months relate to the current accounting year. So out of the 3,600 paid, 5 months premium will be relating to the insurance expense for the current accounting year. 7 months premium is relating to some expenses we are paying in advance, because it is relating to the 7 months of the next accounting year. So it's a prepaid expense. So cash paid out is 3,600, let's say. I'm not doing the journalizing yet. I'm just looking at the accounts involved. Cash of 3,600 paid, of which 1,500 relates to the insurance expense for the current year, and 2,100 is a prepaid expense. So we know what type of account is cash. It's a real account. Insurance expense is a nominal account because it's an expenditure, and prepaid expense is a personal account, representative. So here are 3 accounts getting involved in the transaction. One is cash, the other is insurance expense, a nominal account, and third is a prepaid expense account, because 2,100 of the payment made is for next accounting year. So it's a prepaid expense, which is a representative account, a personal account. So having understood this transaction, these accounts are involved, the journal entry will be journal entry always done with the debit first and credit next. So insurance expense, debit 1,500, prepaid expense, because nominal accounts, all expenses have to be debited. Prepaid expense, it's a representative account. Personal account, the rule for the personal account is debit the receiver. So it has to be debited. They have received the money. The representative account received the money. And cash has gone out. Cash is the real account. Debit what comes in, credit what goes out. So to cash, 3,600. So this will be the journal entry for this particular transaction. Is that clear? So I looked at the accounts which are involved in the transaction. Cash is one account, it's a real account. The other 2 accounts involved are insurance expense, which is a nominal account, and the insurance expense for the current year is only 1,500. Remaining part 2,100 has been paid as a prepaid expense, which is a representative personal account. Now, following the rules of posting, nominal accounts has to be debited for expense, so insurance expense account has to be debited with the amount of insurance expense for the current year 1,500. Personal account you have to debit the receiver. So here the prepaid expense is basically the insurance company has received the payment. Prepaid expense basically is a representative of the insurance company. This is an account which represents the insurance company. So the insurance company received prepayment of premium, advance payment of the premium. So debit the receiver, and cash went out. Cash being a real account, the rule is credit what goes out. So the cash account has to be paid. Example number 2. Stock in warehouse worth 7,200 at market price. 6,000 at cost price is destroyed in fire. Irreversible value of scrap is 500 and insurance company accepts 70% of the balance claim. So what will be the journal entry? Stock in the warehouse worth is 7,200 at market price, 6,000 at cost price. So in the books of account, what is the value for which the stock is shown? Stock will be always shown at lower of the two, that is market price or the cost price. The stock is reflected in the books of accounts at 6,000. So that is destroyed in fire. My books of accounts is reflecting the value of the stock at 6,000 because it will be always recorded at conservatism principle requires it should be recorded at lower of the market value or cost. So the market cost being lower 6,000, so it is recorded at cost. So 6,000 worth of inventory has been destroyed, out of which 500 is the realizable value, so that loss is 5,500. And if insurance company accepts 70% of the balance claim, so balance claim is 70% of 5,500, which is 3,850. So insurance company pays 3,850. 500 is the receipt from the sales of the damaged stock. So the rest is a loss for the company. Now stock is a real account. Stock account, which of the accounts involved here? Stock account is involved. Which of the accounts involved here? Stock account is involved. Then sale of or cash receipt from sale of the scrap, that is cash is involved. What else is involved? Insurance company pays 3,850, that amount is receipt from the insurance company, so you receive, maybe it is paid in cash, so that is involved, and the rest is loss. So stock account was having a debit balance, it's a real account. So what will be the accounts involved? Loss on loss of stock due to fire is one account that will be involved. It's a expenditure. It's a nominal account. It represents a loss. It's a nominal account. Then cash receipt from sale of stock, sale of scrap. So cash account is involved from sale of scrap and from insurance company, whatever claim they have paid. So this is what is involved, and stock account of course. So what is the journal entry here? Stock account is a real account. These are also real accounts. So we have several accounts involved here. One is a nominal account, loss of stock due to fire. The other are real accounts. So the journal entry involved here will be what is the loss of stock? Loss of stock due to fire. 6,000 out of 6,000, 500 came by selling of the scrap. 3,850 came from the insurance. So 4,350. So the remaining amount is loss. So loss of stock due to fire, you have to debit this account. 1,650. Then cash received. Cash is a real account, so cash has been received, 500 rupees from sale of scrap. Cash or bank, if the insurance company paid in cash, let's say, then 3,850 is the and stock account to be created with 6,000. So this will be the journal entry here. So loss of stock due to fire 1,650, cash 500 from sale of scrap, cash 3,850, 70% of the balance amount which has been settled by the insurance company, and stock is 6,000. We'll create it to the stock account because stock is completely disposed now. So this will be the journal entry for the second example. So I think we are approaching the end, so you can submit your feedback. If you have any question also you can ask at this point of time before we close the session. Okay, so we'll close the session today.